Hey guys, TommyBryson here, and today we're going to talk about 7 tips I wish I got when I first started investing when I was around like 19 or 18 years old, where I made some money, yes, but I also lost some money due to some mistakes that I could have avoided if I knew these 7 things right here. So by the end of this video, I'll give you those 7 things, what to do when it comes to investing, and what I'm currently doing today to also avoid all of those mistakes. And by the way, guys, if you guys are new here, I post videos every single day on YouTube, so make sure also subscribe and hit the bell so you get notified. On top of that, also destroy, dismantle, and then put a band-aid on the like button. Really appreciate it. Thank you guys so much. Now, the very first thing I wish I knew when it came to investing was basically, do you want to be a passive investor or do you want to be an active investor? Now, when it comes to active investments, this book right here is absolutely the best book. And I thought initially, hey Tommy, what I want to be is an active investor. I want to be exactly like Warren Buffett and also my man's right here, Charlie Munger. And the idea is that active investors go ahead and select stocks, they buy them, invest into them, while passive investors just basically buy index funds and hold on and get the average return every single year from the market. A lot less risk, a lot less work. Well, most investors, active ones, basically lose money, but the really good ones make a lot of money. So I went ahead, I read this book, devoured it, and then I started going ahead and buying different stocks here and there. But I figured out very quickly that, hey, you know, to be an active investor, I have to read around 3 to 5 hours of financial statements every single day, and that's not something I actually want to do. So I stopped that, and today what I am is basically a passive investor, knowing exactly what I want to do. Make money, not beat the market, but earn the average return every single year and grow my money over time. So the first lesson is basically remove the ego, right? And basically ask yourself, do I want to be passive, invest money, grow over time, be okay with the average return, or do I want to go out there, read financial statements every single day, learn about Warren Buffett, and then go ahead and pick stocks here and there based on facts and knowledge, and not just based on, hey, I like this company or that company, and becoming a speculator. So whatever you want to be, decide and then go out there and do it, but don't do it just for the ego and saying like, hey, I want to be just like this guy or that guy. No. What I want to be is basically have my money grow for me over the long term. And that's why I'm also a passive investor. Now, number 2 is actually a little bit more complicated. But if you are going to be a stock picker like Warren Buffett and also Charlie Munger, the idea is you have to learn about intrinsic value. Now, the intrinsic value of a company is basically valuating the entire company as a whole, finding out its future cash flow, and then discounting it against what's going on today. And that's basically, in English, finding out the real price of the company without including its market share. Now, that might sound complicated, but the idea is, how much is this company worth today as a company, not based on the market value, based on demand and supply. So the idea is very simple, guys, okay? When I want to buy a company, I have to figure out exactly what is the intrinsic value. And by the way, till this day, intrinsic value is a simple formula. It's basically what is the earnings per share number and multiply that by open parentheses, P ratio plus the growth of the company and then close parentheses. A very simple formula, and here it is right here. But that's just a calculation, a formula. Very simple to plug those numbers in once you understand it. But the true intrinsic value of a company is not just that. It's basically, well, what makes this company special? What's the moat around this company? For example, Apple, great company, but does it make the best phones ever? Probably not. And why is it possible to, as you get more customers, you still increase the price, but then still get more demand? It's because basically the brand is so solid. On top of that, the management, okay? Management is very important when it comes to calculating the intrinsic value of a company. And also, how much money is this company going to make me in the future? Notice I said not stock and price. It's all about valuating the value of the company and how much cash is going to bring you in the future. So if you want to learn more about intrinsic value and how to find out, hey, although the market price is $20 per share, I want to find out what the intrinsic value is. And it might be, for example, $15 per share. As a value investor, your goal is to basically go out there and buy below the intrinsic value and not overpay and pay a premium for a company that's not that good. That's the whole goal. And by the way, guys, one more tip here is that I want you to take the lessons from this book and apply it to buying big companies that are good. Not trying to go out there and find like small companies that are terrible. And you'll get what I'm talking about when you actually read this book, which is very important if you want to do stock picking, which I don't. And by the way, if you want to be a passive investor, read this one right here, The Little Book About Common Sense Investing by John C. Bogle. One of my favorites, okay? Now, the third thing I wish I knew was basically controlling your emotions as an investor. Now, you have to be very honest with yourself, and the idea is that if you know for a fact that if you woke up today as a passive or an active investor and your portfolio was down 50%, what would your initial reaction be? You might say, for example, Tommy, no, I'm going to go ahead and buy the dip. In reality, you might say that, but if that actually happens, you might panic and actually sell. So it's very important you think of investing like business. You ever heard about, hey, business is business, okay? But when it comes to investing, business is only business until it's your business on the line. So in a way, you have to separate your emotions from the actual investments you're actually investing into. For example, the way I invest is basically, I invest the same amount of money every single week, meaning I get the average return every single year. On top of that, whenever the market drops, instead of thinking like, hey, well, I'm going to lose money here, I say, hey, I'm going to buy right now at a discount. It's about switching around your mentality and how you actually see, hey, the market went down. That's actually a good thing. And if you are, for example, a stock picker, when the stock market goes down, usually it decreases your risk because it means you can now buy at a lower price knowing the company is actually worth more. The only time you panic is basically if you're borrowing a lot of money and you're speculating and you don't know what you're doing. So be very careful with that. And by the way, link down below to my exact portfolio and what I also invest into. The fourth thing I wish I knew was basically to invest, you need to understand a company and not look at a stock as it was just like a piece of paper or just like a ticking price on Robinhood or Acorns or M1 Finance, whatever it is out there, right? And the idea is that whenever somebody comes to you and tells you, hey, I want to teach you the 3 patterns in the stock market, just pause them and say, hey, okay, first of all, tell me if you found a pattern, why aren't you richer than Warren Buffett? The answer is no. The stock market is literally, for example, a market of companies that come together and want to seek out investments, right? So it's not about the price it's going for. It's more about, hey, what is this company actually worth as a whole? What is its debt? What are its assets? What's its cash flow? Its income statements, okay? What's its 10K forms? Its 10Q forms? It's about doing research on it, and that research to me is very boring, and that's why I do passive investment. But if you want to do the correct way, remember, evaluate the company, not a price or a pattern. It's a company. You can't find a pattern in a company, okay? So be very, very careful with just going, hey, I'm gonna just calculate the chart and find out exactly what it's gonna do tomorrow. Usually, that's not the game you actually want to play. And by the way, for day traders out there, around 80% of them actually lose money every single year, but around 80% of them think that they're actually part of the 20%, when in reality, they're not. Most of them are actually losing money. Number 5, and the 5th thing I wish I knew, is basically spend less time calculating and more time actually thinking. Now, you guys probably don't know this, but one of my biggest mistakes was basically with Walmart. Now, when I was 19, I invested into Walmart between $1,000 to $3,000 because basically I calculated, hey, the company is actually going to do well, but I didn't think about, hey, this is Walmart selling for less money than it's worth. Why don't I want to basically invest a lot of money and go big? And because of that, I lost out on a lot more money potentially. And by the way, I sold Walmart at like $60 to $70 a share when I made around 15%. And today I would never ever do that because basically when I buy a company or an ETF, the idea is I'm going to hold on forever because I'm basing my valuation on the actual company and not the price. So always keep that in mind. A calculation is very easy to do. It's just a formula, but always keep in mind, hey, let's think about this company. Let's think about the business and what it's actually going to do in the future. Spend more time thinking than you do calculating. Something that I learned from this man right here called Charlie Munger. Now, number 6, bet big when you actually find a good opportunity. Again, the same thing with Walmart, but in this case, when you are an investor, your whole goal is to find out the valuation of a company, what it's actually supposed to be going for, its actual value, and when the price hits that spot right there, you go ahead and you start investing money. A lot of it, if you actually bet on the good company. Now that means, for example, say for example, I find out that Coca-Cola is trading for less money than it's actually worth. In reality, why would I just invest a little bit of money, knowing the company is actually huge? Why wouldn't I invest a bulk of money and bet big, knowing that all my facts and all my ducks are actually in a row? So the point is, bet big when you find a good opportunity, but understand also the risk. And that's why number 7 here is you have to remove this one thing. And it's basically falling in love with a company. Now, again, another failure of mine was basically in GoPro. I love GoPro, the entire company. I love the camera. I love the sponsorships they actually had and all the people that actually had as influencers. And the idea is I fell in love with the company, and that made me ignore all the fatal facts about the company and also its financial statements. GoPro was, and I think still is to this point, a terrible company when it comes to financially. And when I invested money, I ignored all of that. And I just went ahead and I invested into it because basically I love the company. Always remember, although you love a company, look at the financial statements and try not to base your decision on, hey, I love this company. No, it's about the facts and what the company is actually worth. Now, guys, those are 7 things I wish I knew when I first started investing. And the last thing here, as a bonus for making it all the way to the end of the video, is basically be very careful in investing into companies that ethically and morally in some way go against what you actually believe in. For example, I would never, till this day, I 100% think that I would never invest into a company that has something to do with gambling. It's just not something I'm into and ethically I can invest into. Now, that does not mean that I won't invest into a company just because basically somebody else in that company likes gambling. That's like separate. I just can't invest ethically into a company that's based around gambling. So remember, base your ethics also when it comes to investing if you want to, but if you just want to do business, that's also fine. That's just one rule I found out when it came to Warren Buffett and also Charlie Munger and the way they also think about investing. And guys, I hope these 7 things right here helped you a lot. And by the way, some reading material here is basically The Intelligent Investor by Benjamin Graham, also the Little Book About Common Sense Investing by John C. Bogle, also A Random Walk Down Wall Street, also Poor Charlie's Rich Almanac. I love this book right here, okay? Which I'm gonna start reading very soon. But I love Charlie Munger, man. This guy is basically one of my heroes. And guys, I hope this video helped you in some way. I'll see you guys next time. Thanks for watching. If you liked it, well, like this video, and top if you're new here, subscribe and hit the bell so you're notified. And if you want to text me or see my portfolio or talk to me one-on-one, join my Patreon link down below or send me a DM on Instagram at TommyBryson. And before I go, if you want to see exactly my portfolio, how much money it makes me, here's that video right here. And also click my face right now. So I'll see you tomorrow. Thanks for watching. And as always, peace.